Florida added more people last year than almost any other state in the country. New subdivisions, new gated communities, new retirement villages popping up on land that was scrub pine and cattle pasture a decade ago. By every measure that usually signals a healthy market, Florida is booming. And at the exact same time, homeowners across the state are opening their mailboxes to find a letter that says their insurance company won't renew them. Not because they filed a claim, not because anything happened to their house. Just a notice and a deadline and a scramble to find coverage somewhere else before the policy lapses. Those two facts sit right next to each other, and most people never ask how. Florida sold paradise for decades, and now the insurance industry is quietly pricing the risk sitting underneath it. This isn't happening in some flood-prone shack 10 feet from the beach. It's happening inland, in Orlando suburbs, in gated retirement communities, where the average resident has never seen storm surge in their life. This isn't coastal, it's inland, in brand new construction with hurricane-rated windows. This was never about hurricanes. Hurricanes are just the trigger. What's actually happening is a collision. Geography running into money, money running into lawsuits, lawsuits running into the cost of lumber and shingles and labor to rebuild a roof. 5 pressures. Same patch of land, all pushing at once. See the stack? The non-renewal letter stops being bureaucratic. It starts looking like the only possible outcome. And by the end of this, you'll understand something that sounds like a contradiction, but isn't. The exact same house, same street, same zip code can be a great investment and an uninsurable liability at the same time. Florida gets hurricanes. Therefore, Florida has an insurance problem. True, but it's not the important part. Florida sits on more insured coastal property value than almost anywhere on the planet, not because the land is special, but because of the shape of the state. It's a peninsula, open water on both sides, so it can take a direct hit from the Atlantic or get run over from the Gulf. 2 coastlines, 1 landmass, decades of development packed along both. Insurers don't price the storm. They price the dollar value sitting in its path, and that number keeps climbing every year with population growth and new construction. A hurricane in 1995 hitting the same stretch of Fort Myers coastline would have found a fraction of the insured value sitting there in 2022 when Hurricane Ian showed up and racked up something like $113 billion in damage. In fact, if you were in Florida for Ian, where were you, and are still with the same insurer? That number is not really about wind speed. It's about what wind speed found when it made landfall. A single updated storm track, 20 miles left or right, can move an insurer's projected losses by billions of dollars. Because the peninsula's geometry means a small shift in direction lands on a completely different concentration of expensive real estate. Frequency isn't really the issue. Plenty of coastlines get hit just as often. What sets Florida apart is the density of dollars packed into every mile of that coastline. More insured value per square mile than almost anywhere else prone to hurricanes. So the same storm does more financial damage here, purely because of what it's landing on. The storm is only the trigger. The real risk was built years before it ever formed, back when the permit got approved, back when the subdivision went up, back when the value around your house started climbing. But hurricanes are the part everyone already understands. The part that broke the market isn't the storm. It's what happens right after, when the insurance company that just paid out on your claim turns around and has to go pay someone else. Because insurance companies buy insurance too, so an insurance company pays out a few $billion after a bad storm season. Where does that money actually come from? Not from some giant vault sitting in Tallahassee. It comes from reinsurance. Insurance for insurance companies. Same way you buy a policy to protect your house, your insurer buys a policy to protect itself. In case your house and 50,000 others all file claims in the same week. No single Florida insurer, not even a big one, can absorb a direct hit on Miami or Tampa by itself. The math doesn't work. So insurers go out to the global reinsurance market, mostly based in places like Bermuda, London, and Zurich, and they buy backup coverage. That coverage has a price, and the industry has a specific name for it: rate online. Rate online, the cost of coverage divided by how much protection you're buying. A percentage. When it goes up, everything downstream goes up too. And after a stretch of brutal hurricane seasons, plus wildfire losses out west, plus flood losses in Europe, Rate Online did exactly that. Reinsurance got a lot more expensive and fast. One well-documented stretch saw Florida reinsurance costs jump around 27% in a single year. And insurers don't absorb that kind of increase quietly. It gets passed straight down the chain onto your renewal notice as a line item you never see broken out, but are paying for anyway. A mid-sized Florida-only insurer, the kind covering maybe 200,000 or 300,000 policies, concentrated entirely inside the state, has almost no leverage in that global market. When a reinsurer in London is pricing risk, they're not thinking about your roof in Cape Coral specifically. They're thinking about wildfire exposure in California, flood exposure in Germany, and hurricane exposure in Florida, all bundled into one global risk calculation. Florida is just one line item in somebody else's spreadsheet, and that somebody else sets the price. That's also why Florida's insurance market is so fragile underneath the surface. These domestic carriers run thinner margins than the big national names you'd recognize. They don't have decades of diversified business across other states to cushion a bad year. So when reinsurance costs spike the way they did, it's not a rough quarter for a Florida-only insurer. It can be the difference between staying solvent and going under entirely, which is part of why the state has watched more than a dozen of these companies collapse or leave since 2020. That price didn't originate in Florida at all. It was set in a negotiation thousands of miles from your zip code between your insurer and a reinsurer pricing global catastrophe risk. And your premium is just the local echo of a price war you never got to see happen. So that's the invisible money moving through this system. But there's a second current running underneath it, and it's the reason Florida's market broke in a way no other hurricane states did. Here's a mechanism most states don't have: assignment of benefits. For close to a decade, it turned Florida into a legal outlier unlike anywhere else. You sign a piece of paper handing your insurance claim over to a contractor or an attorney, and in exchange, they deal with the insurance company for you. No stress, no phone calls, no fighting with an adjuster. Except once you sign that assignment, you're out of the picture entirely. The contractor or the lawyer now owns the claim, and they have every incentive to push it as high as possible, because a bigger payout means a bigger fee. Direct settlement stopped being the goal. Litigation became the business model. And the numbers show exactly what that model produced. Florida, a state with a meaningful but not enormous share of the country's homeowner insurance claims, ended up generating about 79% of all homeowners insurance lawsuits in the entire country. Read that again, 79%. One state. That's not weather. That's a system designed to sue. Nowhere close to storm frequency explains that gap. No other hurricane-prone state, not Texas, not Louisiana, not the Carolinas, comes anywhere near it. This wasn't weather. This was a legal environment that rewarded suing over settling. Roofs became the clearest example of how this played out on the ground. After even a minor storm, one that barely qualified as a weather event, contractors would show up door to door in affected neighborhoods offering something that sounded like a gift: a free roof replacement, No cost to the homeowner, just sign here. What that signature actually did was assign the insurance claim straight to the contractor. From there, the contractor would file, inflate the scope of damage, and if the insurer pushed back on the number, take it to court instead of negotiating. A cracked shingle from wind could turn into a full roof replacement claim backed by a lawsuit. In 2022, the state moved to shut this down. Those changes worked to a real degree. But reform doesn't erase a decade of damage. The reserves insurers, built up to cover a decade of inflated claims, are still sitting on their books. The reinsurance pricing set during those years still shapes what global reinsurers charge Florida carriers today. And the confidence that pushed a dozen companies to leave the state or go insolvent doesn't come back just because the law changed last year. This is the part of the crisis that has nothing to do with wind speed or storm surge. It's a legal and behavioral pattern that got layered directly on top of the weather risk. And it's the specific reason Florida ended up worse off than other states that get hit by hurricanes just as often. One of them built a legal system that turned every roof into a potential lawsuit. So you'd think the fix is obvious. Move inland, get away from the coast. That instinct is about to cost a lot of people real money. Take a retiree from New Jersey who bought in Ocala 5 years ago. No coast in sight, no storm surge risk, no beachfront premium. Felt like the smart move. Then comes the renewal notice that says their zip code just got reclassified for flood risk. Not because of a hurricane, because 3 new subdivisions upstream paved over the land that used to soak up the rain. Inland Florida isn't hurricane-proof. It just fails differently. A storm can lose its surge threat completely by the time it crosses the coastline, wind speeds dropping, headlines calling it weakening, and still dump 1.5 feet of rain over a few hours on flat inland terrain that has nowhere to send that water. No slope, no natural drainage, nowhere for it to go. Some of the costliest recent claims events in the state didn't come from wind at all. They came from water sitting on land that was never built to move it anywhere. That's why insurers stopped thinking in terms of coastal versus inland years ago. They price risk down at the county level now, sometimes down to the specific neighborhood, because a storm that's basically just rain by the time it reaches Central Florida still finds flat ground with nowhere to drain, and flat ground with nowhere to drain is its own category of expensive. Look at what's actually been built on. Huge stretches of fast-growing inland Florida, the metro areas pulling in new residents every year, sit on what used to be wetland or open scrubland. That land had its own drainage system once, slow, natural, imperfect, but functional, soaking up water and releasing it gradually. Pave it, roof it, curb it, and all of that water still has to go somewhere. It just moves faster now, funneled into fewer channels, hitting stormwater systems that were sized for a much smaller town. And here's what makes this genuinely strange. The same population growth driving Florida's boom is the thing making this specific risk worse every single year. New subdivisions, new retirement communities, new commercial strips, all adding insured value into exactly these inland flood zones. At the same time, insurers are trying to retreat from them. The exposure base keeps expanding even as the appetite to cover it keeps shrinking. Growth and retreat happening in the same zip codes at the same time. Moving inland doesn't remove you from risk. It swaps one kind for another you didn't know to ask about. You traded storm surge for drainage capacity, and nobody hands you that trade-off sheet at closing. You just find out later when the renewal notice shows a flood zone reclassification you never saw coming on a house that's never once seen ocean water. Geography explains the retreat. So does the legal environment from before. But neither one explains who's actually left holding the bill. When a private insurer decides your zip code isn't worth the risk anymore, you don't just lose that one company. You typically land on Citizens Property Insurance Corporation, the state-backed insurer of last resort. The name tells you what it was supposed to be, a small backstop. Instead, Citizens has grown into one of the largest home insurers in the entire state, carrying over 1 million policies that private companies decided they didn't want anymore. That growth is not a neutral fact. It means concentrated storm risk, the kind that used to sit spread across dozens of private companies, now sits stacked on one state-run entity. And when a bad hurricane season hits, Citizens doesn't just bill the people it covers directly. It can trigger assessments spread across policyholders statewide, meaning someone in Jacksonville who has never had a claim in their life can end up paying into a shortfall caused by a storm that hit Fort Myers. Retirees feel this first, and they feel it hardest. Many bought their homes specifically because Florida had no state income tax and a lower cost of living than wherever they came from up north. That math worked in 2015. It does not work the same way now, with premiums climbing faster than Social Security cost of living adjustments ever do. A fixed income does not flex. An insurance bill does, upward, every single year. The typical homeowner who paid around $1,200 a year in 2019 is now looking at $6,000 to $11,000. And about 47,000 Florida seniors relocated to other states in a single year. If you are on a fixed income in Florida right now, you already know what this feels like. Your premium goes up. Your check does not. Something has got to give. And here is the part that should genuinely surprise you. The housing market itself has not cooled the way you would expect a full-blown insurance crisis to force it to. Cash buyers and luxury developers keep absorbing new supply at the top of the market, largely unbothered because a 5-figure premium barely registers against an 8-figure purchase. The pain is not spread evenly. It concentrates on the people financing a mortgage, the middle-income buyers, the retirees on a fixed check, while the top of the market keeps humming along like nothing is wrong. 1 in 5 Floridians now go without home insurance entirely. Florida is not becoming unaffordable as a whole. It is splitting into 2 different markets wearing the same palm trees and the same zip codes. Cash-strong buyers on one side, insulated from most of what we have just walked through. Everyone financing on a fixed or middle income on the other, absorbing the full weight of it. 5 pressures now: weather, reinsurance, litigation, inland exposure, and the question of who is left holding the bill. None of them explain the crisis alone. Watch what happens when you stop looking at them one at a time. This was never 5 separate problems. It is one problem, stacked 5 layers deep. Population growth increases insured value. Higher insured value pushes reinsurance costs up. Higher reinsurance costs get passed down as premiums. Higher premiums push homeowners to cut coverage or land on Citizens, which concentrates risk onto one entity right as storm losses and legal costs are climbing at the same time. It is not a chain. It is a loop. Here is the part that reframes everything you just heard. Florida's growth and Florida's insurance collapse are not 2 different stories happening to overlap. They are the same story. Every new subdivision, every new retirement community, every new inland development adds more exposed value onto the same fixed patch of land, which means growth is not happening alongside the crisis. Growth is fueling it year after year, one closing at a time. So this was never really a money problem. The premiums are just the symptom showing up in your mailbox. The actual problem is geography. A peninsula with a fixed coastline, fixed drainage, fixed geology, and an ever-growing pile of expensive property sitting on top of it. Paradise did not get more dangerous over the last 20 years. It got more expensive to insure, because there is simply more of it standing there now than there was before. So what do you actually do with all of this? If you're shopping for a house in Florida right now, here's the highest leverage move you can make. Check the insurance market for that specific zip code before you fall in love with the house, not after. Call a broker, ask what carriers are actually writing new policies there, ask what the citizen's exposure looks like on that street. Do it before the inspection, before the offer, before you fall in love. Falling in love with a house and checking the insurance math after is how people end up stuck with a mortgage on a home nobody will cover. Second, if inland feels like the safe move, ask better questions than what is the hurricane category rating here. That's the wrong question now. Ask about flood zone history. Ask about drainage capacity on that specific block. Ask how the ground handled the last major rain event, not the last major storm. Inland isn't safety, it's a different exposure wearing a calmer name. Third, if you're already there, especially on a fixed income, don't just look at this year's renewal number and panic or shrug. Model it forward. Take your premium trend and your income trend and run them 5 years out, side by side. One of those lines moves a lot faster than the other, and you want to know that now, not the year it actually catches up to you. And here's a signal worth watching. Net migration among 20 to 29-year-olds turned negative in 2024. The people who should be moving to Florida for jobs are starting to leave. Here's the question this whole thing leaves you with. If premiums keep climbing at anywhere near this pace, does Florida stay a place regular people can afford to live? Or does it quietly turn into a state where paradise is something only cash buyers can carry? Is Florida still affordable for people like you? And is Citizens a lifeline, keeping people in their homes? Or a slow motion bailout we're all going to pay for eventually? Right now, nobody in Tallahassee, in the reinsurance markets, or in the state's growing pile of gated retirement communities has actually answered that question. They have just kept building.